Is it time to go bargain hunting on UiPath stock? The ticker is PATH. They just reported the most recent quarterly earnings update. Stock's down about 10%. We'll get into that in just 1 second. And in this video, I'll talk about not only a quick high-level overview, what does UiPath do, but I'll also talk about at what price would I consider buying. Let's dive right in. So full context, I previously did a full detailed overview on UiPath talking about what's their business model, what's their value proposition, and why I think they're potentially unrivaled. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. When a company is potentially unrivaled, it generally means you have a right to win, and if you have a right to win and you are a pioneer in an industry, developing the industry, the largest player, growing the fastest, you have the potential to grow at good clips for years at a time, and that's ultimately what drives the fundamentals that drive shareholder returns. So that's what gets me interested if a company's unrivaled and growing quickly, and UiPath does look like one of those types of companies. So I'm very interested. I just want to make sure I'm getting it at the right price, because any fantastic company with an even more fantastic valuation might just turn that into a mediocre investment. So that's the reason you always have to factor in what's the quality of the business along with the valuation. So I'll leave the link for you to consider if you want to watch the full detail in terms of what does UiPath do or PATH stock do. Quick summary though is they're providing critical tools to businesses that are rapidly growing. The way to think about it is you're talking about machine learning, you're using artificial intelligence, effectively computer vision, looking at what someone's doing on their computer, analyze work people do to find everyday repetitive tasks, analyze data from business applications to understand end-to-end processes. So looking at how someone's interacting across several different business applications. It's tracking your behavior, how let's say Excel interacts with some other customer database or something like that. Then it says, oh, okay, let's centrally capture and manage this automation opportunity. Process improvements prioritized by impact and ROI. So effectively it automates this, so that way the machines can effectively do other people's jobs in the future. And in my prior video I talked about how it had a significant impact, let's say, on customer support types of jobs, where it could reduce the amount of time that you need to do to process a customer complaint. So critically managing repetitive tasks that effectively people don't actually even want to do, so folks can focus on the problems that they enjoy thinking about versus doing the very manual repetitive tasks that are annoying, that actually are better set for a machine learning or an algorithm to do. And not surprisingly, this is just, they post amazing financials, and they're facing an amazing opportunity. 60 billion plus market opportunity, a little under $1 billion in annual recurring revenue, about 726 million, 60% growth rate for their annualized recurring revenue, 144% dollar-based net retention rate. This is one of the best of breed type of figures that you want to see, 144%. That means your prior customer cohort, all the customers you previously had, they're spending effectively 44% net of customers that churn, net of the customers that leave you. That entire cohort is effectively spending 44% more. That is a fantastic business model. That's effectively customers saying, we love this, we use this, we need this. And that's what you want as a shareholder. You want products where customers keep saying, yeah, we're going to fork over this cash because the value proposition is so valuable. It helps. It has such a great return on investment. Yes, we're going to be spending because it helps automate these repetitive tasks that, in all honesty, happen throughout a company. No matter what sort of vertical within a company, whether or not it's finance, customer support, sales, there will always be these sort of repetitive tasks that can easily get automated. So not surprisingly, it is a huge market. Not surprising, the $60 billion valuation, $60 billion market. And they talk about several thousands customers, nearly 10,000 customers, 9,100, and an increasing number of customers that are paying over $100,000 a year in annualized recurring revenue, about 1,200 customers. And so when I previously looked at them, I effectively said, okay, it's currently trading around 70 bucks. That's when I previously looked at it. Now it's around 60 bucks, so it's actually a little under, high 50s, based on the after hours action. And based on my range of assumptions, effectively saying, hey, you have really lucrative gross margins, so you might have really lucrative profit margins in the future. I said, this could maybe have 100% upside to maybe downside of 30%, I was looking at. And of course, this is a hypothetical framework. It's very helpful to think this is effectively what you're playing for if the company executes. You could have, of course, stock price can go higher or lower. You can have valuation expansion. You can have a company deliver better results, but you can also have company deliver even worse results, and this completely falls apart. That's why it's a hypothetical framework in which to consider a company. So I ultimately said in my last video, I said, it's just pretty rich. I called out that I wasn't going to be pulling the trigger, and I didn't. Now since then, it's gone lower as I called out, and as companies update their earnings, and this is a key part of the reason why I don't routinely talk. Investors regularly ask, Daniel, can you please tell me what's your price target for XYZ company? Or this is an amazing company, what's your price target? And the reason why I don't talk about price targets for either buying or selling generally, in this video I'm going to do an exception to that, just to show you over the next few months, this would be the price target I would consider. After that, forget about it, just because price targets I generally view are very stale, because it depends. They get stale very quickly. It depends on the data. And as the data changes, your thesis should change. And that's how I look at this. And you'll see exactly what I mean by that. As you get quarterly results, you should rethink, okay, what's the framework in terms of valuation, in terms of what am I playing for as a potential investor? Ultimately, as you see here, with a wide range of growth assumptions, a wide range of margin, of future growth assumptions, margin assumptions, and end multiple assumptions, that got effectively a range of -30 to 100% upside over 5 years. Long-term investors saying, hey, I want to play for something that's worthwhile over 5 years. Now, since then, they did just report their second quarter results, posted nice 60% increase year over year in their annualized recurring revenue. Their consolidated revenue, total posted 40% year over year growth, and that we'll talk about in just a second. 195 million, that's what they delivered on, 40% growth. You're talking about gross margin of 86%. This is on a non-GAAP basis, so you're stripping out stock-based comp, but GAAP-based gross margin was 82%. So either way, you're talking about very, very, very attractive gross margins. This is the top line margin profile that you would expect for a software company. So not surprising to see very rich valuation for this company. And my previous valuation framework talking about 35 to 40 times sales multiple that we were looking at. And so looking at this company, their second quarter 21 results, compare it to their guidance where they're previously talking about annualized recurring revenue of, let's say, 702 to 704 million. They're hitting it, 726, beating it. Previously expecting 180 to 185 million, beating it. 195 million was delivered. But in this case, they're also guiding to slower growth, or effectively continued growth of around 40% this next quarter, and that's not what Wall Street wants to see. Wall Street wants to see if you're expecting decelerating growth, because in their first quarter they were closer to 60% plus, and now it's actually 40%. It's like, okay, wait a second, what's your growth rate in the years ahead? Wall Street loves it when they see accelerating growth, 30 to 35 to 40. Then Wall Street it breaks their models, thinking, oh my goodness, what's going to be the growth rate for the next few years? Generally, and the reason why it breaks your models is because generally, bigger companies, it's harder to maintain the same growth rate over time. And you'll see this across the board, 99% of the time with companies, unless it's sort of like a commodity-driven business where one year it's like up 5,000% and the next year it's down 60%. But generally, when you're looking at growth stories like this, you'll see a trend of a high growth rate slowly heading towards a lower growth figure that's more aligned with the market, especially if they ultimately are taking more and more share from the market, becoming a bigger player in it. So you start at, let's say, 40%, and you think, okay, 40%, maybe this will annualize growth over the next 5 years of maybe 35%. That's the type of framework that you see, the type of assumption you see in my framework that I consider. And so my previous, updating my thoughts on valuation from previous versus current, currently around $59 a share. One thing to note is that their share count is up a bit, from around 520 million when I originally looked at to 560 million. So that is some significant dilution, that has happened since they've gone public. So I am updating my framework in terms of thinking about, okay, what's your growth rate for this year? 40 to 50% as opposed to the 50 to 70%. So that is going to be, that should impact the stock price, because I think a lot of folks were probably going to think about the same range of growth rates for this year. Oh, now they're going to say, you know what, realistically, it's probably going to be like this. Even though management does have one quarter under their belt, effectively, guiding to one thing and beating it. So the fact that they're guiding to 40%, they just did 40%, maybe a range of 40 to 50% this year, sort of takes out a lot of the upside potential of, let's say, 60 to 70%. That was, let's say, a previously reasonable range to consider. I also, as a sort of matter of prudence or conservatism, I sort of said, okay, you know what, it is 80% gross margin right now, but the reality is they still are unprofitable. They still are investing significantly in their business. And so maybe the more conservative approach would be to say, hey, their end margins are somewhere between 35 and 45% versus the 45 to 55%. So that was my own sort of saying, you know what, let's be more conservative here, in terms of this, because the reality is when things start selling off, it's very possible people say, you know what, you're not even anywhere near these margins. They're nowhere near these profit margins now. Let's take a haircut to that. And that's part of the reason why these unprofitable companies get so volatile, is because these margin assumptions, really play a key role. I didn't really change the assumption of what their growth rate could look like over the next 4 years beyond this immediate year. So these changes alone, the share dilution, share price, the expected growth range for this next year, and the expected margins at maturity, plus I did tweak what I thought, the multiples could be. I actually gave it a little bit of a boost to 35 times for the mid case, kept the low case of 25 times. But still, with these changing in assumptions, it's effectively saying like 60% upside and 40% downside. So those are the changes I made, effectively capping the upside this year, keeping the same growth rate, but lowering margins long term from 55 to 45%. Also, the dilution played a role. And that, honestly isn't a crazy amount to play for, effectively playing for 60% plus over this next 5 years. I definitely, if you have a take, that's very different from mine, saying, Daniel, this has way more upside, you should assume a 50 times multiple, leave a comment below. I'd love to hear what you think I'm missing. Or if you think like, Daniel, there's actually way more competition in this space, it should, trade at a much lower multiple, or there's no way they're going to be able to keep up their growth. Either way, I'd love to hear it, because I'm really impressed with what effectively this robotic process, automation, this whole industry trend. I'm very excited about it, and I think it is the future, and it'll just be ubiquitous over time. And so I am interested in following UiPath, especially if you have a different take on it. And so looking at this, I'm saying, yeah, just not that compelling. Now, what price would I buy? And as I already mentioned, it really depends on the fundamentals. I'm going to do a quick plug here, where if this is your first time tuning in, my name is Daniel, you're watching Unrivaled Investing. If you want to follow my personal journey, what am I buying and selling, go to unrivaledinvesting.com. First week of the month, I call it my full portfolio. By the last week of the month, I call it a potential multi-bagger. And if you're interested, we also have this exclusive community, a Discord server, where I'm interacting with the Unrivaled Nation on a daily basis, answering questions, talking about compelling stocks, and people sharing ideas. So check that out at unrivaledinvesting.com. If you're not a subscriber, please make a point of hitting that subscribe button, hit that thumbs up button if you enjoy learning about potential multi-baggers. And so as I look at this, I would probably, and keep in mind, this is a very short-term framework, because the reality is new data comes in every quarter. You can have new data tomorrow, where they say, oh yeah, we just announced this new partnership and growth rate's actually going to be here, or we're making this acquisition, we got $2 billion in cash on our balance sheet, we're going to buy this company, now our growth rate's going to be over there. And so, or oh my goodness, there's been a problem and we're expecting a deceleration in our business. So a lot of different things can change this, and that's the reason why I've always been very hesitant to say, oh, here's the price I would consider buying. That said, I'm asked over and over again, okay, Daniel, you're able to identify these great companies. At what price would you actually get interested in pulling the trigger? And so that's why I wanted to call this out, sort of as how I mentally think about it. Okay, at what price am I sort of playing where it's getting a little bit more interesting in terms of the risk reward, in terms of what I'm looking at. And so here it is, based on sort of my updated assumptions, this 35 to 45% margins. I would effectively look at a $45 share price. Mid 40s is where I would start getting interested in maybe pulling that trigger. Using the very, very same framework that I was just talking about in terms of that updated framework, I would want to see, probably even low 40s, is to say, oh, okay, I'm looking at least, let's say 120% upside. And then when I'm saying, oh, okay, and that I'm being reasonable about that. Maybe there's room for expansion on their margins. Maybe, their growth rate could be higher. And even this framework at mid 40s, I probably wouldn't be making it a huge position. I'd probably personally, this is not financial advice. I'm just sharing what I would personally consider. I'd probably start it off small, looking at this just for my own personal taste, just because it still isn't like crazy compelling where I'm like, over the next 5 years, I can easily pencil out 500% upside. I'm not doing that here. Here I'm saying, like, based on a very reasonable set range of assumptions, I'm getting like 100% upside. So I'd probably consider pulling the trigger at that point, because the stock price would have sold off significantly from its IPO price. It's now baking in more conservative assumptions. So that's a price I would get more interested. That said, look, things can definitely change between now and then. If the share price gets there, you could have you can even have something that's completely non-related to the company happen. Let's say interest rates were to spike, to 5%, the short-term rates. Yeah, and if that were to happen, like, everything gets reset, because it's like, well, wait a second, my opportunity cost is to get 5% a year. I would really want to make sure my returns are like locked in, so that way I'm not even looking at, let's say, 26% downside. I would say, okay, now I want at least 50% upside. And in fairness, like I called out my most recent potential multi-bagger, and Journey subscribers know all about it. But, like, for example, just for comparison, it's growing at 100% organic growth this year. It trades at 4 times sales and it's profitable, versus what you're looking at here with UiPath or Path stock trading at 30 times sales, not profitable, and half the growth rate, less than half the growth rate. So, that's the type of thing. Okay, when am I going to pull the trigger? Yeah, when these things start checking off and, oh, this seems super compelling. And so and also it's worth calling out, this is part of the reason why you, with high growth stocks, you can often have, and I'm not saying it'll happen for sure with UiPath, but you can have huge gap downs where it'll start at one price and then it'll open down 20-30% lower. And the reason why is you have momentum driven investors that are like, yes, this is a great stock, I'm going to buy it, and they're excited about the story. And it's important to recognize that. It's important to recognize investors that love a good story, that love the that love the fundamental story. I love the story too. But the reason why you have this big gap down sometimes is because the price in which the fundamental investors, like myself, are willing to step in can be huge differences, where they say, well, wait a second, the price in which the bargain hunters or the fundamental investors start stepping in, they go, wait a second, based on this framework, I don't have 100% upside until it's mid 40s. So, like, just screw it. And that's the reason why you can have these air pockets where stocks can just open down significantly lower. Not saying that's going to happen with UiPath, but that is sort of the broadly what can happen with growth stocks, where they sort of get disconnected from where you have these one group of investors, momentum driven investors, and they sort of get shaken out when there's a little bit of bad news. Okay, so who's going to step in? Okay, the next group is fundamental investors. And the price in which fundamental investors and momentum driven investors, they can be way different in terms of the prices in which they get excited about things. And so that's ultimately what drives these these big differences. So anywho, I'm sharing sort of my thoughts on UiPath, what price I'd be willing to sort of start getting interested, start buying, talking about mid 40s, maybe low 40s. Really like the story, think there's a good chance this continues to compound and grow their fundamentals for long periods of time. That said, fundamentals isn't everything. You also need to consider, what price do you pay. Hopefully this video talking about UiPath has been helpful for you. If so, please make a point of hitting that subscribe button, hit that thumbs up button. Thanks so much for watching.